You must know about Elliott Wave Theory. Elliott Wave Theory is a technical analysis method used to forecast the stock market and other financial markets. It was developed by Ralph Nelson Elliott, a professional accountant, in the 1930s. The theory is based on the idea that financial markets move in predictable patterns, and that these patterns can be identified and used to make investment decisions. The Elliott Wave Theory is used to analyze market cycles and forecast market trends. Elliott believed that stock market movements are not random, but instead follow a repetitive and predictable pattern. The theory states that market prices move in waves, and that these waves can be broken down into smaller waves, which can then be broken down further into even smaller waves. The smallest of these waves are called motions, and they are what Elliott Wave Theory is primarily concerned with. Elliott identified 5 main types of waves: motive waves, corrective waves, diagonal waves, horizontal waves, and vertical waves. Motive waves are the primary driver of market prices, and they are divided into 2 types, impulse waves and diagonal waves. Impulse waves move in the same direction as the overall trend, and they are made up of 5 smaller waves. Diagonal waves, on the other hand, are typically found at the end of a market cycle and are made up of 3 smaller waves. Corrective waves are the opposite of motive waves, and they are used to correct market prices after a motive wave has pushed them too far. Corrective waves are divided into 3 types: zigzag waves, flat waves, and triangular waves. Zigzag waves are the most common type of corrective wave, and they are made up of 3 smaller waves. Flat waves are less common, and they are made up of 3 smaller waves, but they tend to move horizontally rather than vertically. Triangular waves are the least common type of corrective wave, and they are made up of 5 smaller waves. Once a trader has identified a motive or corrective wave, they can use this information to make predictions about future market movements. For example, if a trader sees that a market is in the middle of a motive wave, they can assume that the market will continue to move in the same direction until the wave is complete. The Elliott Wave Theory is based on the idea that the collective behavior of investors creates predictable patterns that can be identified and used to make investment decisions. It is considered a form of behavioral finance, as it considers the psychological and emotional factors that can influence market behavior. Critics of the Elliott Wave Theory argue that it is subjective and open to interpretation, making it difficult to test and verify. Additionally, some critics argue that it does not consider fundamental factors that can influence market movements, such as economic news and company earnings. Thanks for watching.